Impact of market cycles on default rates. The impact of market cycles on default rates is significant, as economic conditions directly influence borrowers' ability to repay loans. Market cycles consist of 4 phases: expansion, peak, contraction, and trough, and each phase affects default rates in different ways. Expansion phase, boom, low default rates. During economic growth, employment rates are high, wages increase, and consumer confidence is strong. These factors contribute to low default rates because borrowers have stable income and can make timely payments. Property values rise, allowing homeowners to refinance or sell at a profit if needed. Credit availability increases, making it easier to restructure loans or access new financing. Peak phase, stable or slightly rising default rates. At the peak of a market cycle, economic growth slows down, and signs of instability appear. Interest rates may rise as central banks attempt to control inflation. Borrowers with adjustable rate mortgages, ARMs, may see higher payments. Debt burdens may increase, leading to early signs of rising default rates, especially among subprime borrowers. Contraction phase, recession, high default rates. During a downturn, unemployment rises, wages stagnate, and financial distress increases, leading to higher default rates. Borrowers lose jobs or experience reduced income, making loan payments unaffordable. Declining property values may result in negative equity, where the mortgage balance exceeds the home's worth, discouraging borrowers from making payments. Stricter lending conditions limit refinancing options, trapping borrowers in unaffordable loans. Businesses struggle, leading to commercial loan defaults and a ripple effect across the financial system. Trough phase, default rates, peak, then decline. At the lowest point of the market cycle, default rates typically peak before beginning to improve. Many foreclosures and bankruptcies occur as struggling borrowers are unable to recover. Lenders tighten credit standards, reducing risky lending. Government interventions, e.g., stimulus packages, bailouts, foreclosure relief programs, may help stabilize markets. As the economy starts to recover, default rates gradually decline. Key takeaways. Boom markets have low defaults because of strong employment and rising asset values. Recessions lead to high defaults due to job losses, falling home values, and tighter credit. Interest rate changes significantly impact default rates, especially for variable rate loans. Government policies and regulations can either mitigate or exacerbate default trends. If a borrower believes they are a victim of a corrupt lender, such as experiencing fraud, predatory lending, wrongful foreclosure, or illegal loan terms, they have several legal and financial options to protect themselves and seek justice. Here's what they can do. Gather evidence before taking action, collect all relevant documentation, including loan agreements, disclosures, and closing documents, correspondence, emails, letters, or recorded phone calls, payment history, and bank statements, proof of deceptive practices, e.g., undisclosed fees, inflated appraisals. Communicate with the lender request a written explanation of any discrepancies or questionable practices. Demand corrections if errors are found, e.g., incorrect charges, misapplied payments. Record interactions, where legally allowed, in case legal action is necessary. File complaints with regulatory agencies. Depending on the type of fraud or misconduct, borrowers can report the lender to Consumer Financial Protection Bureau, CFPB, www.consumerfinance.gov, handles mortgage fraud, unfair lending, and predatory practices. Federal Trade Commission, FTC, www.ftc.gov, investigates deceptive loan practices. State Attorney General, handles state-level consumer protection issues. U.S. Department of Housing and Urban Development, HUD, assists with fair housing violations. Better Business Bureau, BBB, helps track patterns of lender misconduct. Seek legal assistance, consult a real estate or consumer protection attorney for legal guidance. Consider filing a lawsuit for damages if the lender engaged in fraud or violated lending laws. Look into class action lawsuits if other borrowers have suffered similar harm. Request a loan modification or refinance. If the lender engaged in unfair practices, borrowers can negotiate for fairer loan terms. If the lender refuses, refinancing with another lender, if possible, may be an option. Utilize foreclosure defense strategies, if applicable. If the lender is wrongfully foreclosing, the borrower can file for a temporary restraining order to halt foreclosure, challenge the lender's documentation in court, e.g., missing or fraudulent paperwork. Apply for government foreclosure assistance programs. Report the lender to professional licensing boards. If the lender is a licensed mortgage broker or banker, they can be reported to the state's Real Estate or Banking Commission. If the lender is a national bank, the Office of the Comptroller of the Currency, OCC, www.helpwithmybank.gov, can investigate. Bankruptcy as a last resort. If the borrower is overwhelmed with debt due to lender misconduct, filing for Chapter 13 bankruptcy may help them restructure payments and avoid foreclosure. Chapter 7 bankruptcy may discharge some debts, but may also result in property liquidation. Signs of a corrupt lender: hidden fees or misrepresented loan terms, inflated appraisals to justify a higher loan amount, forcing unnecessary insurance, e.g., force-placed insurance scams, unauthorized changes to loan terms after signing predatory high-interest loans targeting vulnerable borrowers. Arizona has several Arizona Revised Statutes, ARS, that provide protections against predatory lending practices. These laws help regulate mortgage lending, prevent abusive loan terms, and protect consumers from unfair financial practices. Below are some key statutes. Arizona Home Loan Protection Act, ARS, Parf. 6-1141, Parf. 6-1143. This law specifically addresses high-cost home loans and imposes restrictions on predatory lending practices. Key protections: limits excessive fees and interest rates on high-cost loans, prohibits balloon payments on loans under 5 years, bans negative amortization, where the loan balance increases over time, restricts loan flipping, preventing lenders from repeatedly refinancing loans to generate additional fees, prohibits prepayment penalties beyond 3 years. Arizona Revised Statutes, ARS, Parf. 6909. This statute regulates mortgage brokers and lenders to prevent unfair lending practices. Key protections: requires lenders to consider a borrower's ability to repay before approving loans, prohibits loans made under false or misleading terms, requires full disclosure of all loan terms, including fees and interest rates. Unconscionable contracts and conduct, ARS, Parf. 44-1211. This statute prevents lenders from engaging in unfair, deceptive, or fraudulent loan practices. Key protections: allows borrowers to challenge predatory loan terms in court. Prohibits lenders from hiding fees or including unfair contract terms in loan agreements. Arizona Consumer Fraud Act, ARS Par 44-1521, Par 44-1534, protects borrowers from fraudulent or deceptive lending practices. Key protections: makes it illegal for lenders to misrepresent loan terms or coerce borrowers into unaffordable loans. Allows borrowers to file complaints with the Arizona Attorney General if they suspect fraud. Arizona Anti-Deficiency Statutes, ARS, Parf. 33-729, and ARS, Parf. 33-814. Protects homeowners from deficiency judgments after foreclosure in certain cases. Key protections: prevents lenders from suing borrowers for unpaid balances after a foreclosure, if the loan was a purchase money mortgage on a single-family home, up to 2.5 acres. Additional federal protections that apply in Arizona: Truth in Lending Act, TILA, and Homeownership and Equity Protection Act, HOEPA, require lenders to fully disclose loan terms and prevent high-cost loan abuse. Dodd-Frank Act and CFPB regulations protect borrowers from deceptive lending practices and require lenders to verify a borrower's ability to repay. How borrowers can protect themselves: check lender credentials with the Arizona Department of Financial Institutions, report predatory lending to the Arizona Attorney General's Office or the Consumer Financial Protection Bureau, CFPB. Work with HUD-approved housing counselors for mortgage guidance. Borrowers should act quickly when they suspect lender fraud, as delays can limit legal options. A well-documented complaint and legal support can improve the chances of reversing any damage done by a corrupt lender.